Hello, everybody, and welcome to another YouTube Live. On today's video, really important topic for you, how and tips for maximizing 2022 solo 401k contribution. So I'm just going to set the agenda for today's video. Find that kind of easier. This way you know what to expect when you're watching this video. If you are watching this video after 2022 in 23, don't worry. There's still some really helpful tips to help you maximize your solo 401k contribution. So we'll start with what a solo 401k is, eligibility, talk about the contribution rules, how they work, and then go into some tips for maximizing contribution, especially end of 22 and then in 23 pre-filing of your return. So what's a solo 401k? Essentially, a solo 401k is a 401k plan that's suited and really designed for a business that has no full-time employees other than the owners or their spouses. Okay, so something to remember. It could be a sole proprietor, single member LLC, corporation, S Corp, C Corp, any business works. But you need to have a U.S. business, and you cannot have any full-time employees that are non-owners and non-spouses of owners. So what's a full-time employee? Full-time employees is essentially anyone that works more than 1,000 hours in a year or 3 consecutive years of 500 hours or more. Okay, so those are the two eligibility requirements. You need a U.S. business, and you cannot have any non-owner or spouse of an owner who works more than 1,000 hours in a year, 3 consecutive years of 500 hours or more. Now, of course, 1099s, independent contractors are not deemed employees. So those are all good. You have nothing to worry about. So now you know what a solo K is, and now you know the eligibility. Let's talk about the reasons why you want to establish a solo 401k. And actually, before I get into that, let's talk about when you need to establish a solo 401k for 2022. So thanks to the Secure Act 1.0, which was put into law in end of 2019, you can now set up a solo 401k in 2023 for the 2022 taxable year. The only caveat is if you do that, then the only contributions you can make are employer contributions. You cannot make the employee deferral contributions for 22 if you set up your plan in 2023. Okay. Whereas if you set up your solo K in 2022, you then have the ability to take advantage of employee deferrals and employer contributions. And honestly, that is the best time to maximize your contribution. So first tip is if you can and you want to take advantage of contributions for 2022, set up your plan in 22. Don't procrastinate. Don't delay. Do it in 2022 so you can take advantage of employee deferrals and employer contributions. And this way you'll be able to reach the maximum amount, which is $61,000 or $67,500 if you're over 50, much easier than if you were only allowed to do employer contributions because you procrastinated and set up your solo K in 23 for the 2022 taxable year. Okay, so now we know when you are able or when you're required to set up your solo plan for the 2022 taxable year. So let's briefly discuss the major advantage of setting up a solo K versus another retirement plan. The first is contributions, which I'll spend the bulk of the time going forward on today's video on. But just quickly, as I mentioned, $61,000 or $67,500 if you're over 50 for 2022. If you do a regular IRA, it's $6,000 or $7,000 if you're over 50. If you do a SEP IRA, it's just $61,000. No, if you're over 50, there's no catch up. SEP IRA is no Roth option, no loan option. With a solo K, you can borrow the lesser of $50,000 or 50% of your account value. SEP IRA, you can't borrow $1. Solo K, there's the employee deferrals that I mentioned, plus the employer profit sharing contribution option. SEP IRA just has the employer contribution option. So for example, if you made $100,000 and you are over 50 years old and are a single member LLC, a SEP IRA would only allow you to put in a maximum of $20,000 pre-tax a year, whereas a solo K would let you do in 2022 $27,000, which is the maximum employee deferral if you're over the age of 50, plus 20% of 100, or 47,000 versus 20 if you just use a SEP. So clearly, even my 9-year-old kid knows that 47 is more than 20, and there in that specific instance alone is all the proof you need why the solo 401k is taking over as the most popular plan for the self-employed, right? It comes down to contributions. But when you add the loan feature, the Roth option, plus if you're a real estate investor, you have the ability to use leverage, to use a non-recourse loan to buy real estate without triggering this tax known as the unrelated business income tax, or UBIT, which can go as high as 37% and applies to IRAs on the acquisition of real estate using leverage in an IRA or 401k, or IRA, I should say, but there's an exemption for 401ks under Internal Revenue Code section 514C9, which does not apply to IRAs. So for that specific reason, real estate investors that are self-employed love the solo K because of that exemption to the UBIT tax and the ability for them to use leverage to buy real estate, which is not as tax advantageous in an IRA. So when you put it all together, the solo K is going to win every single time. So now let's talk about contributions, because that's really the heart of today's video, right? We're talking about year-end tips for maximizing 401k contributions. So let's focus the rest of today's video on how to maximize your solo 401k contributions. So again, the first tip is you want to set up your plan in 22 for the 2022 year. Why? Here's an example. Let's say you made $100,000. Keep it simple. Single member LLC, over 50 years old, right? So we know that you can do maximum of $27,000 plus 20% of 100, or $47,000 if you wish. Just to be clear, you do not have to put a dollar in a retirement plan. It's a 100% elective system. This is a private retirement system. We don't live in a Scandinavian country that's going to have a government-run pension system that will put money in for us. We're on our own, okay? For good or bad, we're on our own. And we hope Social Security will be there when we retire, but there's no guarantee, right? When you're born, the government doesn't shake your hand and say, hey, I'm guaranteeing you Social Security will be there. We don't know what's going to happen 10, 20, 30, 40 years, right? All it takes is legislation. If one party retains control of both houses. Now, no one would be stupid enough to cut Social Security. Why? Because you'll never get elected ever again. But the government may be in a bind. They may run out of money. Who the heck knows? So it's up to us. We got to take the initiative and take responsibility for our future and the future of our family. And the best way to do it is through the U.S. retirement system. Why? Deferral and compounding returns. Your money will grow faster when it's not subject to tax. And based off the concept of compounding returns, assuming an 8% rate of return, your money should double every 8 years. And Albert Einstein coined, not me, but Albert Einstein coined compounding return the 8th wonder of the world, right? It's the best way to accelerate wealth accumulation and to build a retirement nest egg fast is through compounding returns. And that's why the retirement system works. It's based off mathematics. Simple as that. It's just based off mathematics. Okay, so focusing on contributions, which is the most important part of the retirement system, because the more you put in, generally the more you're going to have at the end of the day. Yes, you got to get lucky on investments, but as long as you stay between 6 and 10%, which whether you're buying stocks, real estate, ETFs, mutual funds, over a 30, 40-year period, you're going to be between 6 and 10%. Even if you just stay super plain vanilla, super conservative, you will get there. So for me as a tax lawyer, I'm not an investment advisor. I'm not super focused on investment selection. I'm more focused on contributions, on staying focused, on being consistent, on maintaining good habits to annually make contributions to a plan. And then obviously the most important part is trusting the process. Okay, so let's get back to our example. Schedule C, single member LLC, over 50 years old, earns 100K. If that person set up their solo K in 2022, they can max out and do 27,000 plus 20% of 100 or $47,000. If that individual got lazy or procrastinated or just didn't know and is watching this video in February 23, it's like, oh, I'm self-employed, I have a business, single member LLC, no employees, just me, US business. This guy, Adam, seems to know what he's talking about. I guess he's a tax attorney. Let's do it. Calls IRA Financial and says, hey, guys, set up a solo K for me. Well, unfortunately, the rules as of today are as follows. If you set up the plan in 23, all you're going to be able to do is the profit sharing. That 20% of your 100K, you're going to lose that employee deferral, which is a dollar for dollar contribution. In this example, since the individual is over 50, it's $27,000. So the employee deferrals is dollar for dollar, whereas the employer profit sharing is a percentage. Okay, so let me kind of expand on that a little bit more in detail. So in 2022, the most you can put away if you're under 50 is $20,500 as an employee deferral, or $27,000 if you're over 50. Okay, employee deferrals again are dollar for dollar. So if you made $30,000, you can put in the full $20,500. Whereas an employer profit sharing is a percentage. So if you made $30,000 W-2, you can do 25% of 30. If you are a sole proprietor or single member LLC, it's 20% of 30. So that's the only distinction in the profit sharing. 20% single member LLC, sole proprietor, 20% net Schedule C, and then it's 25% if you are a W-2. Okay? Don't ask me why. It's a very complicated, mathematical equation. Why the 25% gets reduced to 20% if you're a sole proprietor or single member LLC, but just know that's the number. Okay, so just to recap, employee deferrals, $20,500 or $27,000 if you're over 50. It's dollar for dollar. That generally can be done in pre-tax or Roth, depending on your plan. Okay, and obviously, if you have a solo K, one of the advantages, you get that employee deferral option, whereas if you did a SEP IRA, all you're getting is a profit sharing. The 20% if you're a single member LLC or sole proprietor, 25% if you're a W-2. Okay, so those are the two buckets, the two components of the solo K. And when you add those two buckets, the $20,500, $27,000 if you're over 50 as an employee deferral bucket, you add that to the 20% of your Schedule C, or the 25% if you're a W-2. You can't go above $61,000 or $67,500 if you're over 50. The point is, clearly, you're going to be able to reach that maximum number if you set up your plan in 22 versus 23, because you're going to get the benefit of employee deferrals plus profit sharing. Whereas if you set up your plan just in 23, you're only going to get the benefit of profit sharing, which is just the 20 or 25% number. Okay, so you're losing some benefits there. When do the contributions have to be made? Well, if you are doing employee deferrals, it actually depends on the type of business you have. If you're a sole proprietor, single member LLC, you can do employee deferrals generally up until you file your 1040, including extensions. If you are a W-2, meaning you have a C or S Corp, you generally have to do employee deferrals by 12/31. Why? Well, if you're getting a W-2, the concept and the IRS understands that you're going to know what your salary is, right? You know what your W-2 is. I'm making 30 grand, 50 grand, 80 grand, whatever it is. If you are a sole proprietor, single member LLC, you file a Schedule C. Now, the amount you can contribute is based off your net Schedule C. That means revenues minus expenses. Almost all small businesses are not going to know that number by 12/31, right? There's checks coming in, there's expenses, maybe deductions, all kinds of stuff that you're going to need to interact with a tax advisor, tax professional, CPA, to kind of tell you, okay, this is your net Schedule C and this is going to be your tax number. That does not happen for most of us until later in the year, maybe before April 15th, or generally definitely before October 15th. So the IRS gives everyone, especially small business, sole proprietors, the benefit of the doubt and allows you to make employee deferral contributions up until your 1040 is filed, including extensions. But if you're getting a W-2 from your self-employed C Corp or S Corp, the employee deferrals need to be made by 12/31. At least the election should be made. Can you write a check in February and date it 12/31? Yeah, I guess you could if your intent was to do it in 12/31. Profit sharing, the employer contributions, that 20 or 25% if you're a W-2, that always can be made up until the business files its tax return, including extensions. So single member LLC, sole proprietor, the employee deferrals and employer contributions can be made up until the 1040 is filed, including extensions, since the Schedule C is part of the 1040. If you're a C or S Corp, employee deferrals should be made and contributed by 12/31. Employer contributions can be made up until return is filed plus extensions. Okay, so now you know what a solo K is, eligibility, why you should set one up, when you need to set one up, the difference between setting one up in 22 versus 23, and ultimately how and when those contributions need to be made. The distinctions: employee deferrals, sole proprietor, single member LLC, up until the 1040 is filed, including extensions. If you're a W-2, C or S Corp, employee deferrals should be filed by 12/31, and the employer contributions filed when the 1120 or 1120S is filed, or 1065 if there's partners, including extensions. Okay, so those are the key tips. One last tip is the mega backdoor. This is super important. Technically, if you've set up a plan in 23, you can still technically do a mega backdoor for 22. What's a mega backdoor? That allows you to go dollar for dollar. So 61K or 67,500 if you're over 50 in Roth, right? So instead of just being stuck doing a Roth IRA of $6,000 or $7,000, the mega, it's called mega because it's mega. The mega backdoor Roth 401k will let you go dollar for dollar. 61,000 or 67,500. You can even keep it in the plan as a Roth or move it to a Roth IRA, even if you're under the age of 59 and a half. So it is the most opportune, most kick butt Roth option out there. Okay, nothing beats it if you're a Roth lover. I wish I can do a mega backdoor. I can't because IRA Financial, we have 80 plus employees in our organization, and unfortunately, the mega backdoor is subject to top-heavy tests and other ACP tests. Which, if you're a solo K, it's just going to be you or other business owners. You're not going to be subject to those complex ERISA tests, and that's why you don't have to worry about failing them. And that's why doing a mega backdoor Roth and a solo K is such an amazing option, because you're not going to fail in the ERISA tests, and you can go all the way to 61 or 67,500 if you're over 50. Simply make after-tax contribution, convert it to Roth, leave it in the plan, and then ultimately you can even move it to a Roth. So really, really awesome opportunity, and that's a secret tip if you're a Roth lover. Most Roth lovers don't even know about this. It's really an unheralded kind of super secret type of option that is legal. It's been legal pretty much since 2014, just not super popular. So that's the final tip of today's video is if you're a Roth lover, the solo K will let you do mega backdoor. And the good news is you can set it up in 23 for 22. So if you're watching this video in 23, you're like, oh, I'm feeling this mega backdoor, you can set up your plan in 23 and still do the mega backdoor for 22. The only time you need to set up your solo K for 22 is if you want to do employee deferrals. Now, there is a piece of legislation floating around Washington called Secure Act 2.0 that I'm hopeful gets passed in 22. The reason I'm not saying it's going to is it's December 14th now, and I haven't heard a lot of rumblings about it. I heard more rumblings a month or so ago. And the idea, there's a provision in Secure Act 2.0 where will allow you to set up solo Ks in 23, for example, and also do employee deferrals. Right now, Secure Act 1.0 allows you to set up a plan, in 23 for 22, but only do employer contributions. This provision in Secure Act 2.0 would also let you do employee deferrals on top of profit share. So, pretty good option there for if it becomes law. Who knows? So to be determined. But just to kind of summarize the tips. Obviously, the solo K is the best retirement plan out there if you're self-employed. So hopefully I've introduced people to that concept. Number two, setting up the plan in 22 versus 23, way more powerful because you get employee deferrals. Next tip, if you're a Roth lover, you could set up the plan in 23 and still take advantage of the mega backdoor and go all the way up to 61 or 67.5 if you're over 50 in Roth. Next tip, if you are a sole proprietor, single member LLC, you have until your 1040 is filed, including extensions, to do employee deferrals and profit sharing. If you are a W-2, remember your intent, you need to make the employee deferrals at $20,500 or $27,000 if you're over 50. That should be done by 12/31, or at least the intent, where letter to file, I intend to make $10,000 contribution. And those are the key concepts of contributions. Remember, you can't go above 61 or 67.5 if you're over 50. Last thing I want to mention, I probably should have mentioned this straight away, but you need earned income to make contributions. So if you have a small business and it's just real estate rental income, passive, Schedule E as in Edward, it's not going to be available for contributions. Only Schedule C, 1099, W-2, compensation for services, business income subject to tax, earned income is available for contributions. Passive income like capital gains, interest, dividends, royalties, rental income, Social Security, alimony, things like that are not earned income because you don't pay Social Security, Medicare tax on it. So therefore, it's not eligible for contributions to a plan. So just something to keep in mind. Got a couple questions. Let me jump into these questions. First one, does IRA Financial have a crypto option for a solo K? Absolutely. Right now, you can set up, you can have a solo K and then pretty much use any exchange you wish to take advantage and take the opportunity to invest in cryptos in a tax-deferred or tax-free manner. Now, there's also opportunities, depending on the exchange, to have more controls over those private keys. Of course, caveat, there's a McNulty case, and I've done a bunch of videos and blogs on the issue of McNulty. The case was very clear. It was a precious metal case and talked about the prohibition of an IRA owner from having unfettered command over an IRA asset. Yes, that was a precious metal case, but tax court opinion was quite broad. So what does that mean for crypto investors that want to hold their private key on a cold wallet? Why would they want to hold their private key on a cold wallet? Well, we know that if the exchange holds your private key, it's not your coin, right? We see that with FTX, with BlockFi, with Voyager. If your crypto is on the exchange, it's gone, right? You may never see it again. Whereas if you hold your private key, it's yours. Now, people want to do it in a cold wallet. The issue is, can you do it in an IRA or 401k based off of McNulty? Unclear. Maybe, maybe not. Generally, if you hold your cryptos on an exchange, assuming this mug is, if you hold cryptos in a USB and a nano ledger, this is the ledger, let's say, clearly I have unfettered command over it, right? So that's the issue. But digital assets are a unique, novel asset. They're not tangible. They're an intangible asset that could be held tangibly. There's also blockchain, which provides transparency and would allow the IRS to follow the crypto wallet to prove that crypto never was used for personal purposes. So that's something that does not exist in metals or other assets that may give the IRS comfort that, yes, even though you have unfettered command, they can catch you if you do anything prohibitive with it. You can also potentially hold these cryptos in a Ledger Nano and hold that nano in a depository, just like gold. It's an option some of my clients have done. But we'll see. Hopefully there'll be some IRS guidance. The unique thing of cryptos, I think, differentiates cryptos from metals and the McNulty case, but without further guidance, just be cautious, tread lightly. There's just not enough to go on other than the penalty case. How long does it take to set up a solo? 10 minutes. You go in our app. You can get customized, set up, going in minutes, and then you get to work with a tax professional who will help you customize the plan. We can even open a bank account for you at Capital One. You can DocuSign everything. We'll help you with the rollover of moving the money from your current custodian to IRA Financial, and then you can ultimately move it out to another plan account or make an investment through that account. So we make things super easy. I've written 2 books on the Solo K. I feel like I've kind of written literally wrote the book on the Solo K. We do it all. Like, we'll customize the plan, we'll administer it, do the 5,500 EZ if your plan assets are over 250. We'll do 1099s if you take distributions or rollovers. We will be assigned a tax professional to help you navigate, understand the rules, i.e. contributions. We'll help you do the loan. You need to take a distribution, hardship, whatever it is, we'll assist you with that. We have the smartest team that will work with you and be there for you to help you navigate those rules. So we'll be able to open a bank account for your plan at Capital One. So you literally can set everything up on your phone. You never have to leave your house, and we'll assist you with the movement of money, open the bank account, customizing your plan, and obviously offering you the consulting services you need so that you know your plan is going to be operating within IRS guidance. Okay, how long does it take to do a mega backdoor? Well, it's super simple. So basically what we'll do, this is what I prefer. I think it makes sense to have separate bank accounts. So if you're going to do a mega backdoor and just a Roth, let's say not have any pre-tax contributions, we'll open no charge 2 bank accounts at Capital One, an after-tax and a Roth. So let's say you want to do a $61,000 backdoor. You'll write a check for 61 or wire 61K into the after-tax Capital One account, and then the next minute we'll convert it, move it over to the Roth sub-account under Capital One, under your plan. We'll do the 1099-R if you need us to do that with a 0 conversion value since you're converting after-tax to Roth. And that's it. So it can be done in minutes. We make it super easy. We open the bank accounts. We'll take care of the paperwork. And I've spent a lot of years perfecting this process, making sure that people can set up plans quickly, it's customized, and obviously assisting with the transfer, the bank account, and then offering the annual consulting services so that you never have to worry about messing up or violating IRS rules, because we will be there for you. We've never had a solo 401k client audited, and if ever that should happen, we will be there with you step by step, because ultimately there's nothing to be concerned about. Why? You're getting plans that have an opinion letter. So the IRS will not attack your plan because you'll have an opinion letter from the IRS saying the plan is valid. If they attack transactions, then obviously we will do our best to assist. Now, if you do something stupid without our knowledge, we'll do our best to help you, but that just doesn't happen. Why? Because our premier annual consulting service, which is basically almost all our clients take advantage of, we'll keep you out of trouble, because you can just notify us by email, chat, phone about any potential investments, questions, things to be concerned about, filing requirements, and the like, so you can make sure you're in compliance. We do audit. We basically kind of have like an audit guarantee for the Solo K, just because if you use our plan documents, you're not going to get audited. If you do get audited, we'll be there to help support your plan, because we're the prototype sponsor of the plan, and you're going to get an IRS opinion letter showing that these documents have been blessed by the IRS. Now, again, if you do something stupid like buy a house and live in it, or just take your 401k or IRA and give it to your mom, it's going to be hard to defend that. Now, not to say we're not going to help you correspond with the IRS, but ultimately it's a self-directed plan. So ultimately, the responsibility of the investments, the decisions come down to you, but we're essentially your angels in the background to make sure that if you need us, we're there to take care of you and make sure you understand all the rules, all the IRS rules, so you don't get yourself into a jam. So just to recap, I suggest if people want to set up a Solo K, don't procrastinate, do it in 22, don't do it in 23. We're actually running specials to actually encourage people to set up solo Ks in 22 versus 23. Why? Listen, I've been in this business 12 years. At least I don't want to give you the number because it's a lot. I get calls in January and February saying, Adam, backdate the plan. I just woke up. I wanted to do this. I talked to you in November. I spoke to someone on your team in October, September. I got busy, lazy, Christmas, Thanksgiving, New Year's, and I didn't do it. And you know what? There's not much we can do. I mean, we just can't really do much. So don't procrastinate. You don't even have to pay when you get set up. If you need to work on a payment plan, let us know. We will work with you. You can pay it out of your business as tax deduction. You can pay it as a rollover. Just set it up. Get that plan going. So this way you have until, if you're not a CRS Corp and you want to do employee deferrals, you have until you file your 1040. So either April 15th, October 15th to do all your contributions. So that gives you a lot of time to kind of figure yourself out, figure out what you can do from a contribution standpoint, and not lose out on contributions. Now, if you lose out on $20,000 of contributions this year, or even $10,000 or $15,000 of contribution, you're never going to make that up. That's hard because that $10,000 or $15,000 in 20, 30 years could be worth 100, 150K. So every dollar matters, and especially because the numbers are so big that you can go all the way up to 61,000 or 67,500 for over 50. These numbers, these contributions make a huge difference. Now, last thing I'll say is, I did speak a lot about Roths, and I'm a big Roth lover. And my accountant, I've got into some, definitely some conversations over some drinks over pre-tax versus Roth. Obviously, in her case, she wants me to do pre-tax. Why? Because it makes her job and life easier because I'm going to reduce my taxable income, right? And it's a lot better when she sends me a bill and say, look how much tax I saved you. My thinking is, okay, yeah, it sucks. I max out my 401k. I'm under 50, so 20,500. So let's say you pay 30% tax. It's a $6,000 deduction. That's nice. That's helpful. But my thinking is, hey, I'm 47, in 25 years, if I can be patient and not touch that money till I'm 59 and a half, like I'd rather in Roth. I don't know where taxes are going to be, but I don't want to worry about it. And I just can't wait till I'm 59 and a half and literally can pull money out of my 401k if I need it. God forbid, if I need it, tax-free. Or if I just want to give money to my kids or buy my kids something, it's all tax-free. So that's pretty cool. But I get it, right? If you just I need to reduce taxes, I need to generate deductions this year. The employee deferral at 20,500 or 27,000 is big, right? It's a big number. An IRA is $6,000 or $7,000. Simple IRA is 14,000. Right, if you make 50 grand, a SEP IRA is only give you 10K, 20% of 50. So being able to go over 20 is huge. So by setting up your plan in 22, you're going to take advantage of being able to do that employee deferral in 22 versus if you did it in 23, all you're going to be getting is the employer profit sharing and not get the 22 employee deferral, which is super meaningful. So I'll leave you with that. Thank you for watching Adam IRA Financial, tax attorney, founder of IRA Financial. Appreciate you guys spending some time with me today. We're here to help. Any questions you have on solo 401k, I work with the smartest people in the business. We spend so much time on training, education, so that we're available to answer any questions you have on any self-directed IRA or solo K. So hope you guys are not too super stressed with your Christmas shopping. Online just makes things so much easier. But I actually went to the mall last, I think Sunday. It was packed. I didn't go that often with COVID, but felt kind of good to walk around a little bit. I feel like a lot of people are diving back into going to malls, just going back to feeling normal again. So that's cool. Otherwise, I want to wish everyone a happy holiday season. And thanks for watching. Appreciate it. Have a great week. And I'll see everyone again next Wednesday. So, take care.